Hello, and welcome to Greenbrier Company's fourth quarter fiscal year 2014 earnings conference call. Following today's presentation, we will conduct a question-and-answer session. Each analyst should limit themselves to only 2 questions. Until that time, all lines will be on a listen-only mode. At the request of Greenbrier Companies, this conference call has been recorded for instant replay purposes. At this time, I would like to turn today's conference over to Ms. Lori Tekorius, Senior Vice President and Treasurer. Ms. Tekorius, you may begin at this time. Thank you.
Thank you, Carol. Good morning, everyone, and welcome to Greenbrier's fourth quarter and full fiscal year 2014 conference call. For those of you that noticed, my name did change. I'm happy to announce I got married earlier this month. On today's call, I'm joined by our Chairman and CEO, Bill Furman, and CFO, Mark Rittenbaum. We'll discuss our results for the fourth quarter and fiscal year ended August 31, 2014. We'll also provide our outlook for 2015 and our new strategic goals. After that, we'll open up the call for questions. In addition to the press release issued this morning, which includes supplemental data, more financial information and key metrics can be found in a presentation posted today on the IR section of our website. As always, matters discussed on this conference call include forward-looking statements within the meaning of the Private Securities Litigation Reform Act of 1995. Throughout our discussion today, we will describe some of the important factors that could cause Greenbrier's actual results in 2015 and beyond to differ materially from those expressed in any forward-looking statements made by or on behalf of Greenbrier. In 2014, we clearly demonstrated the strength of our diversified business model. In financial terms, we had a record quarter and year in revenue, net earnings, diluted EPS, and adjusted EBITDA. In operational terms, we achieved record levels of new orders, production, and deliveries, and we ended the year with the highest level of backlog in the company's history. Highlights for the quarter include adjusted EBITDA of $80.8 million and earnings of $33.7 million, or $1.03 per diluted share, on record fourth quarter revenue of $618.1 million. Now, these results are excluding a non-cash gain of $13.6 million net of tax on the contribution of our repair operations to GBW. We ended the year with over $505 million of liquidity from cash balances and available borrowings on our revolving credit facilities. Orders for the quarter totaled 10,400 new rail cars valued at $1.06 billion, and broad-based demand drove backlog at August 31 to a robust 31,500 units valued at $3.33 billion, of which less than 40% are tank cars. Subsequent to quarter end, we received diverse orders for an additional 11,400 units valued at nearly $1 billion. About 30% of our resulting backlog is in tank cars, compared to 40% at the end of fiscal Q3 of 2014. Again, reflecting the diversity of car types in our backlog, as well as pent-up tank demand pending regulatory changes. In addition to the rail activity, momentum in our marine operations drove marine backlog to $112 million this quarter. We significantly exceeded our goals established in April 2013 of a minimum 13.5% aggregate margin by Q4 and $100 million of capital liberation. In addition, we have now fully executed on our $50 million share buyback and instituted a quarterly dividend of 15 cents per share. And now I'll turn it over to Bill.
Thank you, Lori. Greenbrier continues to roll on down the line with many notable benchmarks achieved during the year and in our fourth quarter just ended, so I'm going to cover just a few of those. Market visibility has never looked better for Greenbrier and for our industry in general. Greenbrier's prospects are strong for continuing to improve margins and operating efficiencies while bolstering strong cash flow. Markets and businesses that have been underperforming for the past 2 years are all recovering, such as repair, double stack, forest products, and marine. All this provides Greenbrier strong tailwinds in addition to strong markets, unlike anything we have seen in recent years and perhaps the strongest in our history, if not the history of our supply industry. I believe these trends will prevail through 2018 and probably beyond that time. And by then, Greenbrier will have completely transformed itself with an optimized business strategy, improving diversification, greater manufacturing efficiencies, and most importantly, wise investment of free cash flow. This transformation commenced more than 3 years ago, has advanced rapidly over the past 2 years. So this is our story. We fortified our business with a triple strategy. Number one, flexible and low-cost manufacturing footprint. which has been ramping and now is set to achieve the efficiencies of that ramping and operational optimization. Number 2, car type manufacturing diversification, including exciting new products. And number 3, a more robust leasing strategy with what we call an asset-light model, featuring enhanced throughput that begins with a diverse and sophisticated new investor base, accompanied by strong lease syndication and asset management activities. New products include our covered hopper car lines, including an exciting car for sand where we have a significant market share and been taking market share from others. Our proprietary automobile carrying cars featuring Multi-Max and Automax, and a newly launched plastic pellet car. Through automation and lean manufacturing techniques, we've also meaningfully reduced our manufacturing cost footprint in intermodal, a car type where traditionally we have enjoyed very high market share, and which is now recovering, and we expect to be robust in the next few years. We've achieved scale and efficiency in tank cars, something many in 2008 believed impossible for a company introducing a tank car product line. And this week, we have begun our first tank car of the future with 9/16-inch steel and safety features which have been described in earlier press releases. Our threefold strategy has dramatically increased market share in the new car market, improved our margins, and boosted our capital efficiency. These new dynamics have served us well throughout the cycle and given the company a different business profile than in earlier cycles. Indeed, today, Greenbrier is a substantially different company, substantially larger, a substantially more valuable company than it was just a few short years ago. Including orders received following the quarterly close, our backlog is about 40,000 units, or $4 billion, nearly a third of just announced industry backlog. With a value just over $4 billion, this is a dramatic increase from the past when our share at this point in the cycle would typically be equal to only 15% of industry-wide backlog. This is striking evidence that our strategy is producing results. We received 37% of new railcar orders placed in the third calendar quarter of 2014, the largest share of any builder. Importantly, only about a third of our backlog is in tank cars for crude by rail, and our remaining mix of backlog is well diversified. Low-cost capacity and product diversification, coupled with a robust leasing business and our strong values, have allowed Greenbrier to realize these new heights, but it is just beginning. Margins are at all-time highs in almost all car types. New car prospects and commercial opportunities have never been better. Our balanced business model, along with our core values and value proposition for customers, and the communities in which we operate, are all working very well. I'm proud of what our teams have accomplished, and for what they are going to accomplish. We deeply value the hard work of our employees and our various teams of specialists whose excellence and support of customers make all this possible. So what's the future look like for us? Well, we believe both the tank car market and general freight car markets will be buoyed by the energy renaissance in North America. Replacement demand will be robust for both retrofit and new car production. As safety percolates into the consciousness of the American public and the shipping community, and particularly the shipping community and the supply chain, we believe all these things will occur. Indeed, Greenbrier has been a leader in advocating for tank car safety, and we believe our leadership will be rewarded as the next few years play out, and the national tank car fleet is upgraded and replaced in almost all hazardous material cars. There are approximately 170,000 such DOT 111 cars that can be and should be made much safer, either through replacement or retrofit. The older fleet should be recycled. Non-qualified energy cars should be remarketed into less hazardous service. Likewise, cars in hazardous service, not now in the regulatory crosshairs, such as those transporting pesticides, herbicides, and caustic substances, also need attention, given that they can still damage the environment and cause death and damage to habitat and rivers. Remember, and all you have to do is remember the Dunsmuir spill in the pristine Northern California Sacramento River several years ago. That was big news then, and if that situation were to repeat itself today, it would again be headline-grabbing news. Why is that important? It's important because rail transportation is an iconic part of North American history, and for the most part is safe and efficient. providing high quality and reliable service for goods and commodities of all descriptions. In fact, rail transportation has only itself to blame if our industry, along with the supply industry and its customer base, snatches its feet from the jaws of victory, as an industry sage used to say that we are capable of doing. As long as trains operate on rails, there will be derailments. When these derailments occur at high speeds with huge mass, and when they're transporting hazardous materials, what could consider to be a manageable accident under normal situations can indeed become a catastrophe. And it doesn't have to be this way. We can avoid this type of thing with safer tank car designs and reasonable retrofits using the principles of triage. Safety for our industry is not an option. Recent events have shattered communities, and the industry's hard-earned trust has been shaken. We cannot allow public trust in railroading to falter further. This is part of who we are. Railroading is America. We do not want our industry to fall victim to the kind of loss of public confidence we've grown accustomed to seeing in the modern public relations environment. We don't want to have franchise value destroyed by high-visibility accidents at the cost of lives and extreme property damage. For there to be a sense of renewal and healing in these communities and beyond, trust must be restored, and it's incumbent upon all of us in the supply chain, in the shipping community, and the rail operations to do our part. Again, safety is not an option. We believe the next course of action to restore public trust will be when the DOT finally announces its new rule requiring safer tank cars and safer tank car designs. Retrofit options for legacy tank cars will also emerge once the new tank car design standard is established. Both retrofits and new car design are doable now and at a reasonable cost. We know it's doable because we are doing it, and so are others. Our industry should welcome these long overdue requirements, not impede them. This is why the U.S. government needs to act now to bring about sensible tank car design standards, which we all know can be made much better than today. We favor PHMSA's Option 2 design, which we have called the tank car of the future. And as I said, we are building that car